Thank you so much for joining us this evening. We have an amazing webinar planned for you folks, and we're going to be covering the power of incorporating. My name is Vince Tomich, and it is my pleasure to be co-hosting this webinar tonight with our partner, Tony Watson from Robert Hall & Associates. My role as a real estate advisor is to learn as much as possible about each investor and help them accomplish their short-term and long-term goals. As a rental property owner myself, I take great pride in assisting our investors with finding properties that meet the specific criteria that we establish as a team. For those of you that are not familiar with Marshall Reddick, I want to take a quick second to explain who we are and what we do. So we are at Marshall Reddick are a full service real estate firm, and we focus on three primary services. Those include real estate brokerage, property management, and private lending. So for our brokerage, we help people buy and sell here locally in Southern California, as well as help investors purchase in any of our 16 out-of-state markets that we do business in. I will be able to, on the next slide, I'll be able to provide a slide that shows you which markets we're active in. So for our property management division, 99% of those investors who purchase with us need property management. So we're going to cover everything from A to Z. That includes showings, marketing, renting background checks, rent collection, rent disbursement, repair requests, even evictions if it gets to that point. And our final service is private lending. So for our private lending, we actually have two clients. We have borrowers and lenders. So for our borrowers, typically our short-term borrowers include people looking to do fix and flips, build spec homes, or we also have the long-term borrowers who are those who can't qualify for conventional financing, maybe because they have over 10 properties, or they may be looking to use their retirement account, their solo 401k or self-directed IRA to invest in property. On the flip side, we have lenders. So the same way that we have individuals investing in real estate, we have that same opportunity to invest in mortgages, whether those are short-term or long-term. As I mentioned earlier, we're in 16 different markets, so I wanted to take a moment to highlight the areas that we are in. These are some of the major metropolitan markets that we have found a lot of success in investing in. What you'll notice is that there's a handful of these markets that have a green box around them. Those are markets in which Marshall Reddick has a physical presence. So we actually have agents in those markets, brick and mortar structures, property management. We have people that can get to boots on the ground in those particular areas. The areas that are not highlighted, we leverage our relationships with some of our referral partners to help with some of the property management and real estate sales. Okay, so I know that you guys have signed up for the incorporating webinar, so I just wanted to kind of give you a quick overview of what you can expect from me when I reach out post-event for a consultation. So these calls can be as short or as long as you'd like. Many of you are going to be interested in the structuring of the various entities that we'll be covering tonight, and I'm more than happy to point you in the right direction to get that accomplished with Tony and his team. There's going to also be some of you that are interested in adding property to your portfolios or inquiring about property management, and I can assist with that as well. It's my job to go over the who, what, when, where, why, and how. Here you can see a little description of what that entails. There's going to be some goal setting, why you may want to do some of these options, how evaluating your options, in what format you'd maybe make a purchase. Time frame is important, setting your criteria, identifying the markets, and introducing all the key players involved. Tony being one of those key players, especially when it comes to the incorporating topic that we're on this evening. Okay, before we bring Tony up, I just want to get a quick poll question out there. This will help Tony as well as myself understand who's out in the audience this evening. in where we are in terms of incorporating. So all of these questions are, no one's name is revealed, but we will just see a percentage of the answers. So if you can just click the following, choose the following that best describes you. All right, awesome. So looks like we have, most of us already have an LLC. Very few have an S Corp. There is it looks like a majority or a good amount that also is interested in setting up an LLC. And then there's a large majority that they have neither and looking to learn more. So that is a great segue into bringing in Tony, who's going to be able to go over all of these items in much more detail and the tax implications involved. So let's see. Without further ado, I'd like to introduce Tony Watson. Tony Watson from Robert Hall and Associates. So go ahead, Tony, you can take it away.
Great. Thank you so much for having me as a presenter today. Like you had mentioned, I've been working with Marshall Reddick and their company for quite a bit now. I met Marshall back in, I think, 2007, 2008. And when I sat down to have lunch with him originally, I knew right off the bat that our two companies would work very well together, because obviously when you invest in real estate, whether it be a primary residence, a rental property, or if you're looking to flip property, for instance, just a short-term rehab type business, the first thing that you should be aware of is that there has got to be some sort of tax implication for investing this money in this large depreciating asset. And so the tax industry and the real estate industry, they really go hand in hand in more than just a few ways. So tonight we're going to focus mainly on how to unpack the new tax reform and some major changes for real estate investors across the board. From the poll, I see that most people are interested in LLC, so we'll talk mainly about that as well. I'll mention a couple things about the S Corporation, not go into too much detail, and obviously if anybody has any questions after the webinar, feel free to reach out to Marshall Reddick and they will redirect you right over to our office at Robert Hall and Associates. So without further ado, we're going to go ahead and get started here. Just a little bit about who we are. We're based out of Glendale, California. We've been around since 1971, very much still a family-run operation here at Robert Hall and Associates. In fact, Bob Hall sits right down the hall from me in his office still. Not working full 6-day weeks anymore, but definitely putting in the hours to make sure that his legacy is continuing to grow. We have roughly about 45 people working for our firm, but we service filings in all 50 states. So I know that some of you might not be sitting in California listening to this webinar tonight. And if you aren't in California, just understand that as a tax professional licensed by the federal government, I have the ability, our firm has the ability, all of our tax preparers have the ability to file and assist with tax filings in all 50 states. So that's pretty unique about our firm. So to get right into it, let's talk about the major differences between the two most common entities used in the real estate or small business realm. The LLC and the S Corporation. LLC, most people, and actually just in the seminar I gave this morning, an in-person seminar, I had asked, I told the audience and I asked everyone what they thought LLC stood for. And some people said limited liability corporation, some people said limited liability company. And so at the end I said, well, what do you think it is? And so it was almost a 50-50 split. LLC actually stands for limited liability company. It does not stand for limited liability corporation because as an LLC, even though you are an incorporated entity, you are actually not a corporation. LLCs file articles of organization and not articles of incorporation. And so LLCs being the most popular entity structure that people usually choose, especially when investing in real estate, LLCs do exactly what their name states. They limit liability. And obviously the largest asset that you and I will ever invest in our lifetime will probably be property of some sort, land and building. And so large depreciable assets are protected best under limited liability companies. because that's exactly what you want. You want to limit the liability on this valuable, appreciating asset. The reason why most people, or the reason why actually anybody would not want to put property into an S corporation is because S corporations, unlike LLCs, all the assets are owned by the percent of shares or the amount of shares that one owns of that corporation. And understand that when you put a property into an S corporation, you solidify that as a contribution to your corporation, meaning that if you contribute a $500,000 property to your S corporation, you are exchanging that property for shares of the corporation. So let's say 10 years down the line, you decide that you want to take the property out of the S corporation and maybe add a spouse or a child or a grandchild to title. The day that you distribute that property back to yourself from the S corporation, you trigger a capital gain tax requirement by the federal government or under federal code, even though you didn't actually sell the property. And so S corporations do not allow you to put in and take out property as easily as an LLC does. So LLCs are used mainly for limiting liability on businesses. And the largest asset that, like I said, you and I will ever invest in is normally most likely going to be a property. So when you acquire title for a rental property, if you don't have an LLC, don't worry, because the LLC can always be structured. And not everyone in the webinar tonight needs an LLC. Not everybody does. So you want to make sure that you have this discussion with a financial advisor, a tax advisor, or a tax attorney about whether or not an LLC is right for you. If you feel like in your investment that you have greater risk and liability because of either the area that you're investing in or the tenants that you have, those are two factors that might play into you deciding whether or not an LLC is needed. But those are things that need to be discussed before jumping through that hoop to start a limited liability company. One, because you don't want to incur these additional costs to have the LLC if it doesn't actually provide any major benefit of limited liability protection for your asset. And in a lot of cases, people feel like, well, I have enough insurance to protect me in case anything happens, and therefore I do not need an LLC. That's a common thought process. Make sure that you understand one thing about LLCs and S corporations, though, is that entity structures provide a completely separate or different type of benefit than your insurance policy provides for your business. Insurance is there and in place to pay out settlements in case an unforeseen event happens. That's why we have insurance. And so therefore, insurance is there to pay out some sort of cash value in case the house is flooded or the house burns down or that there's an earthquake, right? So here in California, we have California earthquake insurance, which is very expensive. And obviously people are jumping for fire insurance now or upgrading their fire insurance because of all the fires that are happening. But the insurance policy actually has a value at the end of the day, right? An LLC doesn't really provide any value. What it does is it creates an added layer of asset protection to protect you personally from any potential liability that's on large depreciable assets. And once again, it doesn't provide the same benefit as an insurance policy does. So if you have the insurance policy in place, yes, it might protect you in case any potential event happens where it needs to pay out. But I'm not going to take a poll because everybody's sitting in the webinar tonight, but I'm pretty sure that we're all in agreement that insurance companies are not in the business of paying out settlements, right? And if I could hear all of you, there's probably a couple chuckles in the webinar right now because, yeah, insurance companies, they might pay out the settlement, but they do have the opportunity to say, well, because X, Y, and Z happened, we are not going to pay out the full settlement or we're not going to pay anything out at all. And so at that point, where does the opposing attorney come after? What do they direct their attention to? Well, they'll direct their attention to the asset and see if they can get some sort of payout from the asset itself, which is then the liability is on you. It's not on the insurance company. So just make sure that you understand that the LLC and the insurance policy, they provide a completely separate benefit. The LLC just is an added layer of asset protection. And in most cases, it gives the investor peace of mind that they have this added layer of limited liability protection. The S corporation and the LLC, they both provide great asset protection, but LLCs are normally used for property ownership, whereas S corporations are used for self-employed ventures. The great thing about rental properties is that as you collect rental cash flow and as you pay off the debt attached to the property, that you're not actually paying any Social Security or Medicare tax on all of the rental income you're collecting. You're only having to settle up with Uncle Sam in whatever state that you live in, if there is state income tax where you live. And so that way, on rental property, you don't have to contribute to these social pots, whereas under an S corporation with a self-employed business, if you're selling property as a realtor and you're receiving commission income, you actually pay federal tax, state income tax, wherever you live, and then you also have to contribute to Social Security and Medicare. And so therefore, out of the two entities for the self-employed business owner, the S corporation is going to win out of the two options because the S corporation, it actually will end up saving a self-employed individual from paying the maximum Social Security and Medicare tax. In fact, in most cases, an S corporation can cut Social Security and Medicare tax by upwards of 60%. So once again, LLCs for rental property ownership, S corporations more for the self-employed ventures, even maybe some property managers in the webinar tonight. Property managers would also benefit from the S corporation. Now, if some of you in the audience are saying, okay, well, I have an LLC, but I am also self-employed, should I start an S corporation? Well, don't do anything just yet. Definitely have this conversation with your tax advisor or with someone here at Robert Hall & Associates, because if you need to convert your LLC to an S corporation for that tax benefit, we can file a document with the IRS that states that we are converting the LLC solely for tax filing purposes to an S corporation, and that way you don't have to pay all of the extra fees for setting up a whole new entity. So once again, kind of redirecting it all back to having the right advice, talking to the right professional. Don't listen to your neighbors or your coworkers or your family members unless they're tax professionals, then listen to them. But most people get their advice from the incorrect resources. Definitely utilize the resources that Marshall Reddick has available for you, as well as any of their referral sources. They are a wealth and a very good hub for potential referral sources with professionals. All right. Let's move on to, let's see if we can get to the next one. All right, so a big part or a big change to the new Internal Revenue Code, the new tax bill that passed as of 2018, not really as of 2019. This will be actually the second year that we're filing under this new tax bill. One of the major changes or additions to the tax bill is something called the QBI deduction. Now, QBI stands for Qualified Business Income. It is also known as Section 199A of the Internal Revenue Code. You don't need to know all of those names. I just wanted to give those out to you in case you had heard it termed, in conversation with other professionals as something different. There's a couple names for this benefit. And the QBI deduction essentially tells the taxpayer that if they have enough qualified business income reported on their return, and I'll talk about what qualifies for QBI income in a second, that if they have enough income, they meet income requirements, that they could potentially qualify for 20% of their qualified business income to be received tax-free. Now, we all like that phrase, tax-free, obviously, right? So how do we qualify for this benefit? Well, like everything under the Internal Revenue Code, some people will qualify for it and some people won't. And so this particular benefit, it's all about finding out how to qualify for this benefit. Now, let's start with just discussing and defining what QBI is, qualified business income. A W-2 is not qualified business income. Social Security income is not qualified business income. Interest income and capital gain income, not qualified business income. But rental cash flow from rental properties, self-employed business profit from selling property or from flipping property, any sort of passive or non-passive income that generates and reports on your individual return could potentially qualify for this QBI deduction benefit. Okay, so what the heck is this benefit then? Tony, you're dragging this along. Give us all the information already, right? So in order to qualify for this huge benefit, if you are single, if you're a single filer, your taxable income, after all of your deductions have been taken into account, your net taxable income, if you're single, has to be at or below $157,500. Now remember, the taxable income is after all of your deductions. It's not your gross income. because a lot of people get confused with that. It's not total what you deposited into your account. It's not what's reported on the 1099. It's actually the number after you've deducted all of your expenses, including the primary residence mortgage interest, the property taxes, the charity, or your standard deduction if you take the standard deduction. So your taxable income is the net number. So if you're single, in order to qualify for this benefit, your single income taxable income has to be below 157.5. Now, if you are married, it's double that. So if you're married, your taxable income has to be at or below $315,000 in order to qualify for this benefit. Now, let me give you an example of why these numbers are important to understand, especially moving into the last part of this year, the last part of this decade, actually, is that right before December 31st, if you are married filing joint and your taxable income is at $350,000, well, at that point, you're above the $315,000 threshold, and you will not qualify for this benefit. Well, let me give you an example of where somebody would qualify, and I'll break it down a little bit further for you. Let's say that you're married filing joint and you are at below that 315 threshold. Let's call it $300,000 of taxable income. And let's say that one of the spouses is self-employed and generates $200,000 of passive income, right? So qualified business income, and the other spouse, let's say, has a W-2 of $100,000, so adding up to $300,000. Out of that relationship, remember, we have W-2 income and then we have other business income. The only amount in this calculation or in this scenario that would qualify as qualified QBI, as qualified business income, is the $200,000 that's earned by the spouse that is self-employed or has rental property cash flow. The spouse that has the W-2, that $100,000 W-2 would not qualify for this. So the way that this works is that because this couple has $300,000 of taxable income, and it's under 315, so they qualify for this benefit, that the first 20% of the qualified business income, so the $200,000, the first 20% is tax-free. Well, 20% of $200,000 is what? It is $40,000 of tax-free income. And so this is a huge benefit for a lot of individuals who can qualify for this Section 199A benefit. If you can imagine two self-employed real estate investors, each making $150,000 at $300,000, if it's all qualified business income and no W-2 income or anything, that's 20% of $300,000. That's $60,000 of tax-free income on your federal tax return in 2018, 2019, and until this part of the bill changes again. So the name of the game for this part of the Internal Revenue Code is all about qualifying for it. So if you are that individual, if you're single and you're sitting at $170,000, which is above the 157.5 threshold, you need to figure out before December 31st of this year how to either maximize money in a deferred retirement plan or making improvements or spending money to improve some of your rental properties, and that would reduce cash flow. Anything that you can do to reduce your taxable income and drop you below that $157,500 threshold if you're single, and $315 if you're married, so that you can qualify for 20% of your business income tax-free. So the name of the game is qualifying. If you do not know what your taxable income is, or you didn't know what your taxable income was in past years, you can always send a copy of your previously filed return to Robert Hall & Associates as part of our free consultation that we offer, and we can review a prior year filed return and figure out if you would qualify for this 20% net revenue benefit. That's all part of this the free consultation that I'll mention it again at the tail end of the webinar, but that's something that we can absolutely help and assist with. Like I said, under this new tax bill, it's all about qualifying for this major benefit. And if you are in a state that has tax liability, not the Texases or the Floridas or any of the states that have no state income tax, you're going to want to, if you're in California, for instance, you're going to want to understand that California and other states have not conformed to this part of the Internal Revenue Code. So this is only a federal benefit. It is not a state benefit. But once again, you got to make sure that you qualify for this benefit. Okay. So moving forward, let's see if I can click to the next slide here. And it's There we go. All right. So once again, QBI, also known as qualified business income, it doesn't include interest income or dividend income or unemployment or Social Security or W-2 income because that's not qualified business income for this benefit. It has to be income generated from real estate activities or from self-employed revenue. Let's say you run an online business and you sell things on eBay. That's qualified business income. And so make sure that if you can, deduct as much as you possibly can within reason to get you below these thresholds to qualify for this huge credit. Now, I did want to show you kind of how the S corporation, moving back to the very beginning, I wanted to show you how an S corporation could really end up saving a self-employed business owner a significant amount of income tax. So as you can see from this example, on $100,000 of profit, as a sole proprietor / LLC, which the LLC provides no tax benefit because it only limits liability, you can see that on an average, let's say 25% tax rate federally, 9.3% state, and then obviously as a self-employed individual, you'd have to pay 15.3% of your profit into Social Security and Medicare. That's a lot of money that you're leaving on the table, right? If you flip this self-employed business to an S corporation, you actually get to control the amount of money that is subject to Social Security and Medicare tax. So as you can see, the federal income tax does not change. The state, I'm using California state income tax, by the way. So state income tax doesn't change. And if you're in a state that has no state income tax, great. I'm very jealous. And for self-employed tax, as you can see, it did not stay the same. So the S corporation doesn't necessarily save you federal and state income tax, but what it will do is it will reduce your Social Security and Medicare tax by upwards of 60%, because the only amount that you are subject to Social Security and Medicare on is what you've taken as a salary from the corporation, which as a corporation you're required to pay yourself a minimum salary of at least 40%. So if you want to learn more about how the S corporation game can be played with this, definitely take advantage of our free consultation and we can map this all out for you. Even at about $50,000 of profit at the very bottom, it's still yielding you an overall tax savings of about $4,590. So if you meet the requirements, like I said, incorporating is not going to be right for everyone in the webinar today, all 84 attendees. But hey, some people might be, a light bulb might be turning on saying, wow, I didn't know that I could potentially save money if I am self-employed by filing this S corporation. These are important calculations that need to be mapped out for you so that we can retain some of your profit or more of your profit and not end up paying it all to Uncle Sam. I tell every client in every seminar that I've ever given, dating back to 10 years when I first started doing seminars for RHA, that it is the right of every taxpayer to plan to pay less tax. And if you fail to plan, you're probably going to be planning to fail, right? I mean, you gotta put a plan in place prior to the end of the year. A lot of people put a plan in place prior to the end of the year in order to pay your obligation in tax and not a penny more than that obligated amount. So if you want to discuss this more, absolutely feel free to reach out for the free consultation to Robert Hall & Associates. Now, let's talk a little bit more about the real estate deductions and how those change under the new tax bill. As of 2018, not 2019, but last year, the federal government decided to change the mortgage interest deduction on primary residencies and second homes. So not rental properties, but the home that you live in. And if you are lucky enough, or if you've invested well over your lifetime and you have the money to own a second home for personal use, that would also be included in this particular change. Under the old tax bill, just to give you some insight into how the old tax bill worked, is that when you bought a home to live in, you were allowed the mortgage interest deduction on the first $1 million of acquisition debt. So if I bought a home for $1.2 million and I put $200,000 down, I was allowed on the $1 million loan that I had on the property, I was allowed the full interest deduction on the $1 million amount. That was on my primary, and then I was also allowed the interest on the first $1 million of debt on my second home. That was under the old tax bill. Fast forward to 2018's tax reform, the federal government decided to take that $1 million limitation and drop it to $750,000. Now, that might not impact everyone in the webinar tonight, but understand this, that in states like maybe New York, in states like Texas, in states like Hawaii and California and maybe some other states throughout the U.S., the mortgage interest deduction was a big-time tax savings deduction on the individual return. So as you can imagine, there were a lot of people that were very confused as to why the federal government would take or adjust this large beneficial write-up that most taxpayers were taking advantage of. Well, I noted down here that $750 limit on homes purchased after 12/15 of 2017, just to remind you that the only homes that are subject to the new limit of $750,000 are the homes that were purchased after this date. So if you already had a home with a mortgage, let's call it, your loan over $750,000, let's say you had $1 million mortgage on a loan on a home prior to December 15th of 2017, you are grandfathered into the old tax bill. So you are not subject to this new limit. Now, you can refinance that loan. You could pull out equity lines of credit. It's not going to change the deduction on the $1 million of acquisition debt. So just be aware of that. It's for only homes that were purchased after December 15th of 2017. And remember, this is only for the home that you live in or a second home. If you take that home, either your primary or your second home, and you turn around and you rent out the property, there is no limit to what you can deduct in mortgage interest if it's a rental property. So once again, you could have a $3, $4, $5 million loan on a 15-unit complex or maybe one large property, and the interest will not be limited because it is a business. One thing that I also tell a lot of clients in my webinars is that this new tax bill is very, very pro-business. And so therefore, most of the benefits have been dished off to the business owners, which if you own a rental property, you are a business owner, whether you like it or not. The two main components of any business are income and expenses. And what does a rental property have? It has income and it has expenses. So understand that when you talk about the limits that we're talking about right now, these only pertain to the primary residence and a second home if you own it, not your rental investments. So just be aware of that. Now, for mortgage interest deductions, make no mistake, these are still great, great tax write-offs. However, you also have to understand that every dollar you pay in interest will not save you a dollar in tax. So some people will argue with me on this, and I know that out of all debts that you can have, mortgage interest debt is probably the best debt that you can have. Credit card debt, no, not good. Student loan debt, it's a necessity in most cases, but not a good debt to have. Mortgage interest, at least it's debt attached to an appreciating asset. And so at that point, yes, you might be getting a huge write-off for that on your individual return. But by no means does every dollar of interest you pay Chase or Bank of America or Wells Fargo, every dollar you're paying them does not save you a dollar in tax. What it actually ends up saving you at the end of the day is whatever your effective tax rate is. So if you're in the 20% effective tax bracket, 20% effective tax rate, a dollar in interest paid to the bank only saves you 20 cents in tax. So as you move forward with your real estate investments, the only true way to positive cash flow in your investments is to slowly pay down your mortgage debt. And at some point when you have enough of it paid down, yes, you want to double down on that investment, maybe pull out some equity and buy more real estate. You want to plug your money into long-term appreciating assets that the federal government allows you to deduct expenses against, right? That's the benefit of having real estate. You let somebody else pay for the debt by putting a renter in your property. And at the end of the day, the federal government allows you to deduct everything pertaining to that property to avoid, not evade, because remember, tax evasion is illegal, tax avoidance is not. So every dollar you're investing back into your rental property is a dollar that you are avoiding paying tax on. So it's a beautiful, beautiful thing. Anyway, the mortgage interest deduction, great all around. Just make sure that it's giving you or saving you enough and giving you the correct ROI, on your return. This is a discussion you need to have with your tax advisor. Rental properties, no change. Now, let's talk about the SALT deduction, because for those of you who are in the webinar that are outside of California, maybe in a state like Texas or Florida where there is no state income tax, this probably won't pertain to you as much as it would other states where they both get hit with state income tax and property tax. Under the new tax bill, the federal government, when they were rolling out the reform part of the bill, which is actually 8,000 plus pages long, the federal government did not have a couple states at the forefront of their mind. They were not really thinking of California or New York or Hawaii or some other states that tend to have higher income tax as well as high property taxes. They were really trying to think of how they could generate obviously more revenue and limit this deduction to where it wasn't going to impact everyone, but it would impact high income earners and get them to pay a little bit more tax overall. So what they did was they capped what's called your SALT deduction starting in 2018 at $10,000 total. Now, SALT, once again, stands for state and local income tax. And let me break that down as to what is all kind of part of this SALT deduction. This includes your property taxes you pay on your primary residence, the property taxes you pay on your second home, not your rental properties. Remember, rental properties, we're not talking about these limits because rental properties are allowed all of their property taxes as a write-off. So it'll be the property tax you pay on your primary, your second home, the state income tax you pay on all of the revenue in a state that taxes you on your income. That includes your DMV fees, and then also your sales tax that you pay on items that you purchase in, for instance, if you live in California, in Los Angeles, it's 9.25%. So that would all be included in the SALT deduction. What most individuals were up in arms about is they look at their return and they saw, well, between everything in my SALT write-off, I usually deduct, let's say, $30,000 in state and local income tax. So in their mind, they're thinking, wow, I'm losing $20,000 of this write-off. Well, a lot of taxpayers don't understand this about the old tax bill, but under the old tax bill, there was actually already a limit in place to what you could deduct as far as state and local taxes are concerned. And this limit is known as alternative minimum tax. So I'm not going to go into too much detail about AMT tonight because it's like Pandora's box, and as soon as I open that one, we'll spend 2 hours talking only about AMT. But I did want to mention that a lot of the changes that happened under this new tax bill, they might not impact you in ways that you thought it would. Just because under the old tax bill, if you were making $150,000 to $160,000+, you might have already started phasing out from being allowed any of your property tax deduction and state income tax deduction. And at about $250,000+ of income, most individuals were fully phased out from being able to take any of the SALT deduction because of this thing called alternative minimum tax. Now, if this is just so confusing, you're trying to wrap your mind around it, obviously you can go online and look all this stuff up, but I would not suggest that. I never send people to Google for tax questions. I never said, just like you wouldn't go on Google and try to diagnose your own medical issues. That's like, once again, it's like Pandora's box. It'll tell you that a cut on your arm, you have some deadly disease. So you want to avoid that, right? You want to go directly to the professional that is licensed to advise on this topic. I can tell you right now that after 2018's tax season ended, all of this year when we were preparing taxes for last year for 2018, I could tell you that the general misconception was that this particular change was going to impact everyone in a negative way. When in fact, yes, I'm being very general, but there are a small portion of us that were impacted negatively by this. But for the most part, most people didn't really know that there was already a limit in place under the old tax bill. So I guess what I'm trying to get at between the mortgage interest deduction that I talked about, if I can go back really quick, between the mortgage interest deduction and the SALT deduction, understand that it will make a change on your tax return, but it might not impact you in the way that you assumed it would impact you. So once again, sit down with your tax advisor, map out the road for the rest of 2019 and figure out, hey, if there is a limit and I'm being negatively impacted by this, what are some of my options to kind of navigate these waters? How can I get some benefit to kind of offset something that might have been a negative implication? I'll give you a couple examples just so that it makes better sense. Let's first give an example of how this mortgage interest deduction really works. So let's say you bought a home, January 1st of 2018, which is clearly after the December 15th deadline. If you bought that home, and let's say that you bought it for $1.2 million, again, you put $200,000 down, and now you have $1 million mortgage. But now you're subject to this new limit of only deducting interest on the first $750,000. In your mind, you're thinking, well, I'm losing the interest deduction on $250,000 because at one point I was allowed it on $1 million. Now I'm only allowed it on $750,000. So you're thinking, okay, well, if my interest rate is 5% and 5% of $250,000 is $12,500, Tony, what I'm losing is a $12,500 deduction. Well, yeah, if you look at this particular part of the Internal Revenue Code, this slide in particular, a $12,500 write-off, let's say you're in the 20% bracket, would have saved you about $2,500 in tax. And you're saying, well, Tony, $2,500 is a lot of money. Yeah, absolutely, you're right, it is. But you have to, I think what most people are forgetting is that this isn't the only change that happened under the Internal Revenue Code. A lot of other things changed as well, including the income brackets. So remember that when you actually file your tax return, you file under roughly 7 tax brackets, right? Under 2017, those brackets ranged anywhere from 10% up to 39.6%. Under the new tax bill, they range from 10% up to 37%, but most of the brackets have shifted downwards, anywhere from upwards of 6 to 10%. So my question to you is, okay, if you lost the $12,500 write-off and your refund was reduced by $2,500 just because of this change, what happened to your overall income bracket? Because if you dropped 4% in your tax bracket on $100,000 of taxable income, that means that you were actually saving $4,000 in tax liability because of the change to your income bracket. Well, I mean, if you're saving $4,000 there, but you're losing $2,500 here, and let's say because of the SALT deduction, you lose another $2,000 in overall deductions or overall tax savings. Well, at that point, when you add it all up and look at it not in a micro way, but if you look at it in a macro way, look at how it all works together, that's almost at a break even. And I found that, and especially our firm has found that most people really didn't see a negative change from this. They were seeing really small changes, but because I prepare mostly taxes for real estate investors and small business owners, I actually ended up handing good news out most of the time during this last tax season because this new tax bill is very pro-business. It's pro-real estate. It's pro-self-employed 1099 contract income. We could talk about the tax breaks for the eBays and the Amazons and the Googles and the Fords of the world, but at the end of the day, they have a certain amount of income and a certain amount of deductions and probably a team of accountants or maybe a whole division of accountants that help them file in ways to save them money. At a much lower level or a much smaller level, where we file at, there's still the same benefit, but you don't have the $1 million of fees to pay accounting advisors to help you pay less tax, right? So it's up to you to figure out, hey, am I working with the right team, number one? Am I working with the right tax advisor? Does my tax advisor know about a lot of the changes of this new Internal Revenue Code? And is he or she really maximizing a lot of that benefit? And obviously, you want to know just enough to be dangerous. You don't want to know how to file your own taxes, but you want to know how to navigate around some of these limits. And more importantly, you want to understand one thing about your tax return. Your tax return is unique. It is different from everyone else's tax return. There's never been a time where a client has come in and then the next client who came after them had the same exact tax return as the person before. No two tax returns are alike. You and your neighbor might have the same amount of dependents. You might be in retirement. You might own 2 rental properties. But at the end of the day, your bottom line tax liability could be completely different because of a couple thousand factors that aren't being calculated here. So just be aware that when you look at these individual parts of the Internal Revenue Code, you have to look at it from a macro view. How does it all work together? And how can I navigate around these things so I'm not subject to these limits? Remember that if you take your second home, for instance, and you decide to rent it out, guess what? There is no $10,000 cap to a rental property's property tax payment. There is no limit to the amount of interest you can deduct on a rental investment. So when you rent out your property, you create a whole other tax shelter for yourself, and you file it on a whole other separate form that might allow for more of those deductions to pass through. So just be aware of that. All right. Now, obviously, after most of my seminars, people just have 1,000,001 questions. And that's very common because the tax industry is very complicated. I didn't want to let you know that under this new tax bill, we talked about a couple things that have changed, but a couple other things that have really changed for real estate investors pertaining to 1031 exchanges, for instance. Under the old tax bill, you were able to exchange any business property. Under the new tax bill, that changed to where you can only exchange real property. And real property is actually, a building and land. And you can only exchange U.S. property for U.S. property. You can exchange foreign property for foreign property, but you cannot exchange foreign for U.S. property. So just understand that the 1031 exchange rules have changed a little bit, number one. Number two, with the real estate related deductions, if you are somebody who is improving your property, let's say you just bought your first rental property, you want to dump a bunch of money into that property, there are specific ways to deduct those improvements, and some improvements might be allowed 100% as a deduction to offset rental income. It's too short of a time to go too much in detail about that, but I did also want to mention that if you have specific questions about deductions, about what you can take to offset rental income under your new investments, definitely utilize our free consultation to talk with one of our tax advisors about how to maximize those benefits under your Schedule E rental property investments. One thing that I am asked a lot by real estate investors when they're going out and searching for a new vehicle, because obviously real estate investors tend to put a lot of miles on their cars, and so they're always thinking, well, is my car a deduction? I know that mileage is a write-off at 55 cents per business mile, but what about my actual car deduction? And understand this, that for business owners, for individuals who are fully self-employed in either the real estate industry or online sales industry, if you are a self-employed individual, you can go out and purchase an asset for your business, like a vehicle, and take a bonus depreciation amount for that asset, meaning that if you go out and I'll give you a brief summary of how this works. If you go out and you buy a car that is under 6,000 pounds, I'll get to why the weight is important in a second. You go out and you buy a business vehicle that's under 6,000 pounds, the federal government gives you an upfront depreciation write-off for that vehicle of $18,000. And then the remaining value of the car, the remaining purchase price of the car, is then depreciated over the remaining asset's life, which is 5 years. Now, if the car is over 6,000 pounds, the reason why the weight is so important is because if the vehicle is over 6,000 pounds and you buy this vehicle for business use, it potentially could be 100% tax deductible. So you go out and you buy a Ford F-150 or a Chevy Silverado or a Sprinter van because you're putting people in the back of your car and going and showing them listings in different parts of the U.S. or seeing properties elsewhere. All of these vehicles that are over 6,000 pounds could potentially be 100% tax deductible for your business. So just understand that the rules have changed. That's called bonus depreciation. And if you are interested in learning more about how that works for you in your specific scenario, because remember, just because your neighbor was able to do it doesn't necessarily mean that you're able to do it. Your return is unique. It's special. It's different from everyone else's. So make sure that you know how to qualify for some of these benefits. All right. Obviously, there are going to be a lot of questions. I think that we're going to open up now for a couple other questions in the seminar, so we can get those answered pretty quickly for you here.
Yeah, so Tony, we actually, Taylor was able to send you a few questions. They should be in your chat box or in the question section. We realized that in a normal setting that there is a lot of questions. We've just picked a couple. And for those of you listening, if your question is not answered, our information is going to be provided at the end of this, and we're more than happy to go into more specific scenarios, not on this webinar, but more of a one-on-one. So we did send a couple over to Tony. So let me know, Tony, if you're able to get to those and just work through accordingly.
Absolutely. So right now, it looks like there's 4 questions in my queue right now. I'll start with Winnie Fung's question. What will happen when members of LLCs pass away? So when you have a partnership, and it really, to be real honest with you, it depends on the relationship that you have, because your partner could be a spouse. And at that point, really nothing happens when a spouse passes away, because the other spouse inherits basically all of the assets that the other spouse had owned. So 50%, it automatically defaults to the wife or the husband, so the spouse. If it is a partner that is not a related party, if you inherit that money, well, first off, technically that 50%, let's say it's 50-50 and you share it with a partner, technically that 50% would more likely than not go to their trust, I assume, because if they have done any end-of-life planning, they probably have a living trust set up, and therefore the living trust defaults to the owner of their 50%. And then at that point, their remaining family members could probably call upon you for distribution of any valuable assets within the partnership. But at the end of the day, you definitely want to have that conversation with your partner about who the beneficiary will be of their 50% ownership. More likely than not, when a partner in an investment passes away, the distribution, there's a forced distribution of asset to pay off the remaining value of whatever their shares were or whatever their percent ownership was, and then they're removed from the partnership. But aside from the tax liability side of things, that opens up a whole conversation that is a legal advisor's conversation. So you want to talk to an attorney about that as well, because there are a number of situations that could change even the advice that I'm giving you today. There are a number of factors that could be involved in that. So aside from the tax implication, when a member passes away, even before they pass away, you want to have a plan in place. But if they do suddenly pass away, you want to talk to a tax attorney actually about how to handle the distribution of the asset or payout of the asset value when they do pass. Second question is Flavia Moncani. I believe it says that he or she has left, but they were asking what percent of the income is tax-free. I assume that they were talking about the QBI deduction, and that is the 20% amount. So if you are self-employed and you're making $100,000 of self-employed income, the way that the QBI deduction works is that it makes 20% of your qualified business income tax-free. So the number is 20% to answer his question. And it's a pretty simple calculation, but once again, not everybody will qualify for that because of their taxable income. So you want to sit down and talk with your tax advisor to make sure that you do qualify for this benefit if your income is right at or above that threshold. Next question is Tiffany Tran. I thought the seminar is about LLCs, S Corps, but the discussion seems to be about the changes on new tax law. Well, we talk about the LLCs and the S Corps because they impact the individual return. They're pass-through entities. And so S Corps and LLCs, they play different games. They play on a different playing field than each other because LLCs are mainly for property ownership, whereas S corporations are not for self-employed, for property ownership. Those are for self-employed individuals. And the reason why we talked about the QBI deduction is because a majority of people in 2018 thought that only entities would qualify for the QBI deduction. And because they're pass-through entities, remember when all the magic happens at the S Corp and LLC level and it passes the income through to the individual shareholders, all of the deductions have already been taken into account. So when the money is distributed to the shareholder, that should be after all of the deductions have already been calculated. And so in order to qualify for the huge tax cuts under the new tax bill as business owners, you want to do all of the planning for the entities first before the money passes through to you individually. Now, once again, for Tiffany, if you are more concerned about talking specifically about S Corps and LLCs in more detail, because they're legal entities, if you have legal questions, that wouldn't be a conversation for this seminar. But if you have tax questions, more specific tax questions for your needs, we offer free consultation. So absolutely feel free to reach out to Marshall Reddick, and they'll pass you on to us and give you our information on how to connect with us. And then AM, I don't know what their name is, but if I set up a new LLC from other state, do I need to pay $800 California business fee? So if you are a resident of California, if you reside here, if you register to vote here, you drive around a car with a California plate, you have a California address on your driver's license, you by definition are a California resident. And so therefore, California is one of 8 states that taxes its residents on their worldwide income. So you as a California resident, you can absolutely set up an LLC in Delaware. You can set up an LLC in Florida. You can set up an LLC in any of the 49 states outside of California. And California will still hit you, the resident of California, with your $800 filing fee. It's just your jurisdiction is foreign jurisdiction, meaning that you are not incorporated in California, you're incorporated elsewhere, but the primary shareholder or the primary owner resides in the state of California. So yes, to answer your question, you still have to pay California's $800 filing fee, unfortunately. I call it a parking ticket for parking yourself here in the state of California. All right. It is a tax write-off at the end of the day, so you get a little bit of a deduction on the back end. But yes, there's no way to avoid that $800 filing fee if you personally are a resident of the state of California. So on to Anna Covey. Can I have the LLC file as an S Corp? Yes, absolutely. So I mentioned earlier in the webinar that if you've already set up yourself as an LLC, don't worry, because before the end of the calendar year, you can file a form called a 2553 form. It's called a 2553 small business S election form. And it's a 4-page document, pretty easy to fill out. I would suggest that you have an advisor fill it out for you, but if you want to attempt it yourself, that's fine. And this is something that actually tells the government that, hey, I am an LLC for limited liability purposes, but I am electing to be taxed under the Internal Revenue Code as an S corporation. So yes, you can have an LLC that is taxed as an S corporation, and if you're self-employed, that's a great way to reduce the self-employment tax that we talked about, the reasonable salary payout. And that was a whole slide that I showed you, the little chalkboard example on how to save tax if you have a self-employed business operating under an S corporation. But remember that LLCs are really for rental property ownership, whereas the S corporation is for the self-employed individual, the person who operates and receives self-employed income. Okay, Rakesh Kabra, I'm sorry if I'm butchering your name. I really apologize. Can I open an LLC in another state living in California rental property, not in California either? Remember that you can, but if you personally reside here in the state of California and you invest in property, let's say in Alabama, you can have an LLC in Alabama to protect the Alabama property, but because you reside here in the state of California, California taxes its residents on their worldwide income and therefore will hit you with the foreign jurisdiction filing and force you to pay the $800 here in the state of California. So just be aware of that. You can go elsewhere in the U.S. for great asset protection. That's why most people incorporate outside of California. They want the Delaware asset protection benefit. They want the Nevada Series LLC benefit. They want all of these greater asset protection benefits elsewhere. But at the end of the day, that's all you're getting. You're not getting a tax savings. You're not avoiding the $800 filing fee by doing so. Okay. Judith Nelson, I want to change my Inc. to an LLC. I'm in California. Perfect. So there is an election to recategorize or recharacterize your entity to drop the S election or to drop the C Corp status and convert it back to an LLC. Our department, our incorporating department here at RHA, Robert Holland Associates, we can absolutely help with that. So once again, Marshall Reddick has all of our contact information. They can redirect you over to us and get you all of our contact information and whatnot. I have 5 properties in a couple states here. Would I have to have 5 separate LLCs? Carol Spicer, great question. This is something that is a commonly asked question in my in-person and webinar seminars, and it's not required. Let me just put it that way. But there's something I learned very early in my investment life from a person who I know very well and work with, who is a great investor and made millions and millions of dollars in real estate. He told me very early in my career not to put all of my eggs in one basket. I'm sure that you've heard that saying before. And so what you are doing by putting 5 properties under one LLC is you're putting all of those eggs into that one basket. And a lot of people think, well, an LLC, the veil is hard to pierce. And yes, that is true. That's why we have LLCs. That's why we have S Corps and C Corps. It's to create that added layer of asset protection. But you can absolutely, if the right filing in court is made, if the right argument is made, if somebody has a really high powered attorney and they're paying them thousands and thousands of dollars an hour and they know how to pierce that corporate veil, they absolutely can come after those assets even if they're in an LLC. Now, it's not easy to do that. It takes time, it takes money, it takes knowledge of how to do that. But here in the state of California, for instance, if I have one LLC and it's protecting 5 properties, really the only or the most common way to pierce that corporate veil is for somebody to file something called a charging order in a court of law on one of 4 different accounts, or more than one of 4 different accounts if they really have the argument. Either they're filing it based on malpractice, negligence, ignorance, or illegal activity. And if they can prove that in a court of law, the LLC veil is wiped off the table. And so that's why you have insurance and the LLC, because it's definitely a double-layered protection set up there, because the insurance is there to pay out any settlements in case an unforeseen event happens, and more importantly, the LLC is to separate the asset from you personally. See, when you incorporate as an LLC or an S corporation, you actually have this entity structure that has its own identification number. It has its own social security number, essentially. See, we have identification numbers that we attach assets to. We acquire assets under our socials. And so when you start an LLC, the federal government assigns that LLC or that S corporation its own identification number. That ID number is called an EIN, Employer Identification Number. And so as you acquire assets under the LLC, they're not personal assets anymore. They're actually assets owned by a separate identification number. So when somebody sues you personally, normally they're suing your social security number and any assets that are attached to it. When they're suing your LLC, they're suing the assets that are attached to the EIN number, but not coming after you personally. Could they sue you both? Could they sue your LLC and you personally? Sure. But once again, it takes time. It costs money. And, we all know how much attorneys charge. So unless there is a valuable payout at the end of the day, an attorney will look at an LLC and an S Corp and make the upfront decision of whether or not it's worth proceeding with this lawsuit. And in a lot of cases, because rental properties are normally leveraged with very low cash balances in the bank account, a lot of attorneys won't proceed with that kind of filing because there really is no payout for their client, and there definitely won't be a payout for them if there's no payout for their client in most cases. So just be aware of that. The LLC isn't always necessary. And if you're in Washington, it looks like, Washington is a great state for asset protection. You absolutely can talk more about the legal protection side of things with an attorney in your state. But as far as the tax implications, remember what I said earlier, the LLC provides absolutely no tax benefit. All it does is it creates a greater layer or an added layer, creates an added layer of asset protection and increased limited liability protection. So that pretty much is the gist of the entity selection. Now, once again, if I didn't get a chance to answer your question, because I know we only have a limited amount of time, just understand that this is a specialty of ours. So Robert Hall & Associates, we've been, like I said, open since 1971. We service just shy of about 15,000 filings per year. We see a lot. We file taxes. We have clients in all 50 states. And so if you have investments outside of California where we're based, we are knowledgeable in all other states, and we can help you structure your assets in ways that not only reduce liability, but create greater asset protection and make sure that it's financially worth it for you to do so. Don't just incorporate because somebody told you to incorporate. Incorporate for the right reasons, because at the end of the day, incorporating is a cost to you. It's an added tax filing for you. So make sure that financially it makes sense. And above and beyond anything, make sure that you're working with the right advisors. So hopefully that answered. I don't see any other questions in the queue here. So I'm going to pass it back over to you guys.
Awesome. Thank you so much, Tony. So next, what we are going to do here, I don't know if there's anything else you wanted to mention, Tony, in this section here.
Yeah, actually, let me move the questions out of the way. I did want to throw up a picture of our building just to show you that it's not just me sitting in my closet doing a webinar right now. This is the Robert Hall & Associates building. We basically take up the whole second floor of this building. Like I said, we service tax filings in all 50 states. The main service that we offer is tax preparation. We do tax structuring, so we do incorporate businesses if you need an LLC set up, an S corporation set up. More importantly, if you need to consult with somebody on the different types of entity options that you have available to you, we are great advisors and educators on entity selection and asset structuring and asset protection. Above and beyond anything, we also represent our work in front of the Internal Revenue Service. So if our firm's work is questioned, we have an in-house audit division that will go and represent our clients in front of the Internal Revenue Service. Like I said, we haven't been open for a year. We've been open since 1971. We have great rapport with the federal government. We've seen a lot. Our specialties happen to be real estate and small business. So if that sounds like, this is a good match for you, let's definitely get you set up with a free consultation and get acquainted with your file and see if there's anything that needs to be changed or adjusted or planned for 2019. More importantly, I think I had one more side. You can check us out online, Robert Hall & Associates, at roberthalltaxes.com. We have great reviews online. And most importantly, like I said, we have this free complimentary 30-minute in-person, over the phone, or online video chat consultation. It's free, 30 minutes. What I would suggest to most people who utilize this consultation is to send over their previously filed tax return before the appointment so that our tax professionals can become acquainted to it. acquainted with it, and we can kind of come up with a strategy before we hop on the phone, and that way we can really utilize the full 30 minutes to really, to maximize that time. Most people will think, well, 30 minutes isn't enough. Challenge us and see what we can accomplish in 30 minutes, because I've been able to, I just had a client today. She said, in the 30 minutes that I met with you, you've told me more than my accountant has in the past 4 years. And that makes me feel good, because I feel like I'm doing my job. I feel like I've actually achieved something in that 30 minutes with my client. And we get that a lot here with all of our tax advisors. I'm the one that does all of our seminars, but I'm by no means the only accountant here at Robert Hall. We have 16 accountants who are just as well versed in the tax code as I am. And most of them, in fact, I think all of them now are real estate investors. So you have a unique opportunity to really discuss your business ventures, your hopes, your dreams, whatever you want to discuss with us. Sometimes we even act as counselors in life. So definitely challenge us and utilize us for that free 30-minute complimentary consultation. Obviously, you're not in person to fill this out, so if you'd rather text in, we do offer this service as well. So if you know without a doubt that you want this free 30-minute consultation, you just text RHA to 38470, and that automatically submits you for the 30-minute free consultation. That's because we live in the tech era. I assume that most people are more comfortable with texting nowadays rather than emailing their information or filling anything out in person. So I think that was the last slide for me. I don't think there was anything else. So I did want to mention, though, that in 2020, January 8th, I don't know if that's the last. Oh, perfect. Thank you. January 8th of 2020, Robert Hall & Associates is putting on a real estate summit here in Glendale. So if you're in California, if you're going to be out here, it's a full day of free education. Lunch will be provided. We have a ton of exhibitors. Marshall Reddick will be there. They're going to be one of the exhibitors. It's going to be a great all-day event. As you can see, last year's speakers range anywhere from Bob Hall Sr. himself to Bruce Norris, not Chuck Norris, not the karate guy, but Bruce Norris. He's a big-time real estate developer and investor out of Orange County. We've got a number of other great advisors that are going to be speaking. I'm going to be doing my thing for about an hour on the tax topic. Once again, it is an all-day free event in Glendale, California at the Embassy Suites Hotel. Lunch will be provided. I would highly suggest that if you can make it, whether you live here in California, if you're from outside of California, take the day off, come to beautiful Southern California in January, and enjoy a full free day of education and meet some really, really great advisors. But I did want to throw this back up really quick just in case you didn't get it. If you want the 30-minute consultation, text RHA to 38470. And like I said, if you don't want to do it now, you can always reach out to Marshall Reddick and get our contact information on the back end. All right?
Thank you so much, Tony. And just for you folks online, we will send the slides of this webinar. So in case there's anything you missed or weren't able to get, we'll be able to get that to you. A lot of you guys probably have that question, now what? So basically what's next is I'll be following up with each of you to see what we can do to help. There's very important survey question at the end of this presentation that will allow us to be more effective in serving your needs. So please take the time to fill out those 4 questions once we conclude the webinar. Just in case you guys don't know, for the first timers on with Marshall Reddick, we have a ton of educational videos, articles, and guides on our website. You can go to www.marshallreddick.com/learn, and you'd be able to have access to all of this material as well. Great area to just get more information on a ton of various topics. And we also have our ebook, which is our property rating ebook. It helps give our philosophy on rating individual properties and A, B, and C classes, and how we choose to stick to our particular classes. You can also connect with us on social media. We know we went a little over tonight, so we appreciate you guys sticking in there. If there are any other questions, like I said, I'll be reaching out to you guys tomorrow and Friday, but feel free. Our contact information will be provided via email. So we really appreciate you guys attending. And Tony, again, thank you so much for your time and all of the knowledge you're able to share with us this evening.
Absolutely. Thanks for having me, guys.
You got it. Have a good night, everybody. Thank you so much.